Something we've seen recently is the increased interest in passive income, as well as things like dividend investing and value investing. Defining passive income can be sort of tricky sometimes. Some people will say something like rental property is passive income, although there are certain things you have to do as a landlord to keep up with that property. And sometimes you need to take pretty active actions like evicting people if they're not paying or making a mess of the place. But renting out a property doesn't require you to go in 8 hours every single day to work at some sort of job. And there actually are legal rules on what constitutes passive income and what doesn't constitute passive income. So the regulations can be kind of important, but if we're using the basic definition of, hey, you don't really have to do anything or you don't have to actively go to a job in order to get paid, perhaps one of the finest ways of gaining income passively is investing in the market, at least in stocks that will pay you dividends. And while there are a lot of stocks that will pay you dividends, there's a certain class of ETFs that have really grown in popularity recently. And these are covered call ETFs. Now, I've covered one of these before, and then I've actually gone into detail on how you can do your own covered calls on stocks that you like holding. But I will say that I don't want to have to rehash all of that. So if you're unfamiliar with the concept of a covered call ETF, I highly recommend you watch this video. I'll have it linked in the description as well as the title card. And if you want to learn about covered calls in general, sort of how they function, I'll have this video linked in the description as well as the title card. So hopefully those can be useful background. I'll do a quick summary right here, but I'm not going to go in depth. A covered call is essentially an options play where you sell options on stocks that you currently hold. And because those contracts have a certain value to them, and you need to hold an asset in order to have them be covered, they're a great way of making a lot of money off just holding something. Because you can think, if you sell a call on a stock and that stock goes flying up in value, well, then you just sold a document giving whoever holds it the right to purchase 100 shares of a stock from you. And if the stock is really high up in value and you don't own that stock, you need to go on the open market to acquire it in order to sell that stock to the options contract holder at a huge loss, which is why with covered calls, you are capping your profit, but you're also capping your risk. Technically, these beloved covered call ETFs do work a little differently. Generally, how these actually work is through ETF options. So something like QYLD, which is the largest, most popular covered call ETF, this actually works by holding all the stocks in the NASDAQ 100 index and then writes index options. Index options are different from regular options, and they also sometimes carry different tax laws and usage, things like that. This isn't really something you're going to be doing as an individual. You're just going to be using covered calls on stocks you hold. But this is a lot of times more efficient or makes more sense for a ETF or corporation that is doing things like this, especially one big enough to hold all those NASDAQ 100 stocks. What's interesting is that these are typically European-style options, and if you're selling covered calls, generally that's going to be an American-style option. I just wanted to say that I deeply appreciate your viewership, and that if you like the sort of content I'm putting out and you want to see more, I would appreciate it if you like the video and subscribe to the channel. If you want constant notifications, just hit the little bell icon that pops up once you subscribe. Additionally, if you want to get started in the market and get 2 free stocks to begin with, a fantastic way to start is with Webull. Webull has a mobile, web, and desktop application, and it's a fantastic trading brokerage that I use all the time. The free stocks are literally just free money. I'll have a link in the description of this video to get signed up with them, and if you use my referral link, you'll get these 2 free stocks. I'll also have a little more about them at the end of this video. Thanks for watching, and again, I appreciate your viewership. Anyway, getting back to our main topic of discussion, covered call ETFs. They're pretty interesting. QYLD is the biggest. I've talked about it before. I've linked the video for it in this video. And it's pretty cool because when you take a look at the actual yield, the dividend yield, you can see it's almost 12%, which is absolutely astronomical. There are certain stocks known as dividend aristocrats, which means they have paid out a consistent dividend and they've continued to increase the value of that dividend. Really, it's a good way of detailing stocks that have been incredibly consistent for decades, We can see IBM as an example where they've clocked their 25th straight year of dividend increases. There are a couple rules. Companies must be worth at least $3 billion at the time of each quarterly rebalancing, average daily volume of at least 5 million in transactions. So this isn't happening with penny stocks, but the main point is they want them to pay dividends for at least 25 consecutive years and raise their dividends for a minimum of 25 straight years as well. So these are companies with extreme consistency when it comes to dividend payments, really the gold standard. And if we take a look at a lot of these companies, many of them are struggling to hit 4%. There are some that go over, mainly smaller cap companies that are a bit volatile or have maybe dropped off in profitability but don't want to give up their dividend record, so they continue paying out really high dividends even though they're sort of bleeding for cash. AT&T can be argued to be one of those. AT&T especially really hasn't been doing that hot, and it hasn't grown a huge amount compared to, say, something like Apple, but they've been consistent with that dividend. But we can scroll through all of these and you can see the actual percentages. Really, 4% is pretty dang good. If you're getting a 4% yield on a dividend stock, what's more realistic for a lot of portfolios is something like 3%. Or depending on which companies you want to invest in, the ones you think might have the best future, maybe something like Walmart or Target, those are going to be just over 1%. And of course, there are some companies that fall off this list, which is pretty rough if you're invested. We can go through and take a look at them. It's really sad when you see that happen, but hey, if they're bleeding for cash, they can't just be handing out dividends, especially if their price is falling. So when we take a look at something like QYLD, we realize this is a pretty good deal. This is pretty solid. It's pretty compelling. However, the big downside of QYLD is simply that it is a bit volatile and not that great because it doesn't have downside protection. If we look at the actual share price of QYLD over the past 5 years, we can also see that dividends get paid out more than just 4 times a year, which is pretty nice if you're holding it for the dividend. But we can see there is a lot of ups and downs, and there's a lot of messy things that get involved with this ETF, and it gets a little crazy sometimes. And we can see over those 5 years, it really hasn't increased a whole lot. This is where something like a risk managed ETF comes in. This one is the Nationwide Risk Managed Income ETF. While Global X is responsible for a lot of these passive income covered call style ETFs like QYLD, this one is managed by Nationwide. And you can go to their page on it. It details all the information about it, yields, NAV return, expense ratio, and there's a lot of good details here. They actually have a video that explains some of it. A lot of it is really sweet nothings, nice talk, but basically it utilizes not just covered calls, but also protective puts. So not only are they selling options to make money with calls, they're also utilizing puts in order to actually hedge their bets. And this is to deal with downside protection and help control the price of the ETF. We can continue going down, and they talk about risk mitigation, downside protection, their targets, everything like that. This one is also based on the NASDAQ 100 index. And one thing that they talk about that I actually really like, I wish more companies would do this, is they talk about where NUSI would actually be useful in an actual portfolio. Maybe a complement to the 60-40 allocation, a bond alternative, volatility dampener that may augment existing investment allocations, or just a tool to aid in supplemental current income. Rather than closing out positions and having to pull out money like that, you can just buy a lot of this and sort of hold it and use it as a bit of income from a large investment portfolio. So there's a lot of good here, a lot of details. Fact sheet is pretty nice. Regulatory documents, obviously. But you can go through all of this in a lot of detail. And so far, they have sort of been keeping their promise. You can look at their portfolio, their allocations, everything. They seem to be doing a pretty good job on what they promise. However, the big downside is that options are not free. So when you're dealing with other options for downside protection, you can see their yield is notably lower than something like QYLD. That's right, it's sitting at 7.51%, a lot lower than that 11.8 we saw with QYLD. You can also see the 5-year chart doesn't actually stretch out to 5 years. This is a lot newer. QYLD is among one of the oldest covered call ETFs that's still active. This one is a lot newer, but you can see so far that they have actually gone up in value. Their price, while it has seen some pretty big fluctuations, are actually relatively small, especially compared to QYLD. You can see a low of $23 and a high of $28 when we're looking at the 2020 to 2021. If we try to capture a similar time frame with QYLD, we can see there is a lot of ups and downs, a low of 18 and a high of 24. So a bit more fluctuation, but perhaps a little more importantly is that if we look at the beginning of the year, at the high points, we see that over the course of 2 years about, the actual underlying price for QYLD really has not increased much at all. And a lot of that is due to the volatility really taking a toll on the actual price of the ETF. However, if we take a look at our downside protection, we see that is not the case with NUSI. There obviously is fluctuations, nothing is perfect. We do have to consider the scale though, and we see a slow, steady increase. And in theory, it's going to be a lot more stable holding the long term than it is holding something like QYLD. Now, obviously, you do have to do a little math to see which one is worth it. While the price might be higher here, QYLD is obviously going to give you larger dividend yields. So even if you're down on the actual ETF, each share of the ETF, you might be up on the dividend side. And really, that's where it becomes a judgment call. Both of these can be pretty good to hold if you want to convert your financial account into something that's paying you interest, something a lot better than a 0.1% bank account. But you do have to realize there is volatility in the market. And if you want to hold this long term, you have to consider, what do you plan to use this for? Do you just want income from it? Or is this going to be a pseudo emergency fund for you? I always recommend having some cash on hand, but you don't want to have too much on hand just sitting there unless the market is really dying. It might make sense to put a lot of that money in something more stable. So if you have to pull it out, it probably won't hurt you too much if the economy isn't doing so hot, but it won't murder you because of a giant, seemingly random dip in the market that has a huge effect on a derivative ETF, a call option ETF. So really it's up to you when it comes to the use case. Both of them are very similar to each other. One has downside protection, and the benefit of the downside protection is obviously less volatility, less huge drops like this, especially when you consider the spread. But at the same time, this ETF is fairly new to market, so we're going to want to see a larger range of financial events before we can make a super definite judgment. But for most respects and the information we have so far, it really does seem like it is less volatile. We can see that put protection is working quite well. The only downside is you're making less money per dividend for the amount of money that you put in, a lower yield, by a pretty significant margin, actually. We were just talking about how 4% or so is very good for a dividend stock. Are you willing to forego all of that? Additionally, if you want to hold 100 of these and sell options, you can for NUSI, as well as QYLD. But you have to consider, because NUSI is far less volatile, the options are less prominent and worse priced. So if you really want to sell covered calls on your covered call ETF, it would make more sense on QYLD, even if that gets a little strange, because otherwise you really don't have a whole lot of options with NUSI, which makes sense for something that tries to control volatility. There's a lot to consider with these percentages. Again, it's kind of hard to compare the two because one has way more historical data, the other one is a lot newer. But if we kind of look at things like year to date, we see a 4.33% growth with QYLD. And then with NUSI, we see an 8% yield. Now, again, when you get to 1 year's, all of that, it's pretty difficult to compare, but it does seem a bit more stable. And of course, whenever we're talking about covered call ETFs, it is important to mention the Big Daddy ETFs, the actual NASDAQ and S&P 500 themselves. We can see over the past 5 years, we've seen pretty good growth. Even if you bought during a down point or a rough patch in the market, if you just held for a couple of years, you would make a lot more money holding the S&P 500 as some sort of ETF like SPY or QQQ. You would have made a lot more money than you would using a covered call dividend strategy, unless you timed things extraordinarily well and held specific stocks. Generally, the market is going to beat things like that, and while it is awkward to have to close out positions for profits, especially if you want money out of your account, it tends to be the better option. But of course, a bear market can occur. A bull run doesn't go forever, and we've seen some arguably super inflated stock prices, especially recently. When it comes to a flat market, that Q yield is going to be particularly powerful. Same with NUSI. Now, is the extra downside protection worth it if the market is flat? Well, it depends how much volatility is there. It is sort of a balancing act, and the big reason it's a balancing act is because if the market isn't volatile, then options aren't worth as much. So it is very strange. Sometimes it can be hard to predict the behavior, but really you're not looking for a huge market collapse. You're looking for a nice mix of flatness where your covered calls are going to be profitable, but the actual price of your ETF doesn't tank. And NUSI can be a bit more resilient when it comes to things like that. But depending how previous patterns go, it is sort of hard to see either of those beating out the S&P 500 or the NASDAQ or any of the other big ETFs that have been pretty consistent performers. But again, that's going to depend on market conditions. And if the market gets bad, despite having downside protection, depending how bad it gets, you might just want to pull out. So it's difficult to say. There's a lot of nuance with every single one of these. And of course, you could always just run covered calls on your own favorite stocks rather than putting it all up to an ETF, even though an ETF does a lot of the work for you. But hey, I hope you appreciate this video. Best of luck in the market. If you have any questions, feel free to leave them. And I'm more than happy to respond and get you guys up to date. I'm going to try to go through more of these different covered call ETFs because there are a lot of questions and a lot of interests about them. Best of luck in the market. If you're interested in investing in the market with self-directed trading, a fantastic way to start is with Webull. If you sign up now using my referral link in the description of this video, you'll get 2 free stocks valued up to $2,300, which includes companies like Google, Facebook, and Starbucks, as well as many others. All the money in your account is yours to invest, trade, or withdraw as you please. It's your money. There's 0 fees associated with depositing money. You just get your stocks and you'll get your buying power immediately. So if you want a fantastic mobile, desktop, and web trading brokerage, just use the link in the description of this video. Thanks and happy trading.